Hey, what's up guys? John here. Home prices are plummeting, like 2008, 2009 all over again. And this time it's going to be very different. And the reason it's going to be different is because before was very unique. This situation that we're walking into right now, we're walking into an environment where interest rates were 3%, now they're 7, 8% for a mortgage. You might say, John, there's no way mortgage rates are not at that price point. And if you have the average credit score in America, which is a 698, it's a 7.656%. However, if you have bad credit, 640 or even 660 to 679, it's 7.921%. That's a huge change compared to 3% about 14 or 15 months ago. What's ultimately happening here, if you were a buyer making $100,000 per year and you got $100,000 in cash, so you had very low debt $250 a month. I mean, this is the ideal type of buyer, $100,000 a year, $100,000 in cash, you could afford a $423,000 property. Whereas that same exact buyer would have afforded a $556,000 property just last year. So the difference, $130,000 in pricing power has been lost just over the last 13 or 14 months. And what is very likely to happen here coming very soon is we are going to see the higher end markets, such as the $600,000, $700,000, $800,000 markets and above, $1 million plus, of course, is going to be greatly punished. Because what's ultimately going to happen is when you're, let's say, buying a house for $1 million, I know it sounds like a lot of money, but that mortgage payment 12 months ago might have been $4,800 a month, which is not that crazy. I mean, it's expensive, sure, but the average rental in America is $2,100. So, I mean, it's twice the cost of the average rental. However, that same mortgage today might be $7,000 a month. That's a huge difference, the difference of roughly $3,000 per month. I believe what we're going to see is the higher end market get absolutely devastated, and I think there's going to be upward support on the properties priced around $300,000 to $450,000. And that support is going to be a lot of buyers, a lot of home buyers going down. So they're going to be going and buying properties under their budget to make sure that they can afford it inside of these uncertain times. And with these buyers, there's also going to be renters that are going to try to get into home ownership. There's going to be institutional buyers that are going to try to buy up these properties simply because they would make great rentals. They can buy a $400,000 property, a $350,000 property, and turn around and rent it for $2,000 or $2,500. They are going to do it, especially when we are watching the fiat currency, the dollar, the greenback get absolutely decimated. We're walking into an era in which the dollar is going to have a very hard time remaining the dominant currency, over the next decade or so. Home prices are dropping like it's 2009. Home prices are now posting the biggest monthly declines since January of 2009, according to the latest Mortgage Monitor report by Black Knight. Median home prices in August fell roughly 1%, 0.9%, only slightly better than July's 1.05% monthly decline. The average home price is down 2%, which is $8,800 from the peak nationally. As we enter the historically slower fall-winter home buying season, the housing market has not seen such a significant 2-month drop in prices since shortly after the collapse of Lehman Brothers. In the winter of 2008, Black Knight said on Monday, skyrocketing mortgage rates now in the 7% range for some buyers. I mean, for all buyers, it's in the 7% range. You may see, on certain websites, 6% or 6.25%. Try to actually get that loan. That loan is no longer available. Mortgages now are, 6.9, 7, 7.25, 7.5. I mean, that's where rates are right now. And if we are going to increase interest rates 2 more times by the end of the year, I can promise you, and the mortgage-backed security market is looking very rough, I can promise you rates are likely only going to be going up. And limited inventory has driven mortgage affordability to its lowest level since the early 1980s, a reversal from the frenetic boom in buying during the 2020 and 2021. With mortgage rates now at 6.7% as of September 29th, it takes 38.2% of the median household income to make a monthly mortgage payment. Traditionally, how people would really look at it is you want to be able to bring in 3x what the mortgage payment is. So if you're making, let's say, $10,000 a month, which is a lot, but just for easy math, that would be, $3,000 a month. You want that mortgage payment around $3,000 a month. If you're making $6,000 a month, you'd want $2,000 a month allocated to your mortgage or less. We're moving into an era where property insurance is increasing, property taxes are going up, utilities are going up, job instability is going up. Cost of living, food, everything is getting much, much more expensive. And with it, home prices, something has to give. And it seems like it's going to be the housing market. Payment on the median priced home bought on a 30-year fixed rate mortgage and 20% down, Black Knight said that monthly payment is up $930 from August 2021, a 73% increase. Historically low inventory, along with record low interest rates, was one of the key drivers behind the U.S. home prices, essentially a decade's worth of appreciation in just 2.5 years, added Black Knight's president. Creating a path to success in today's purchasing market, meeting the needs of a new generation of home buyers while managing the ebbs and flows of a volatile housing market is a major endeavor for any mortgage lender. So what should some lenders do to thrive in the face of a post-pandemic housing market? What we are very likely going to see here is we're going to start to see a lot more fear enter this housing market. And this is a great time to be an investor, to be a home buyer, not to actually buy, but to study and watch how the consumer confidence changes from buyers and how sellers are really beginning to shift their mentality, realizing that, hey, you know what, I might have missed the housing market. The peak time to sell probably was sometime in Q3 or Q4 of 2021. And, either I have two options. One, I can reduce the price and try to find a seller now, depending on your market. Some markets are stronger than others right now. Some markets are almost unfazed. But what we are starting to see is we're seeing a trend in the housing market found in many markets. And what I believe is ultimately going to happen is I believe it's going to spread nationwide, and we're going to really start to see home prices fall. And they're not going to fall equally. I believe some markets are going to fall much more dramatically than others, but I do believe all housing markets are going to go through a very, very big transition. Home prices are beginning to fall from post-pandemic peaks, but remain up 12.1% from August due to record growth seen in late 2021 and early 2022. Black Knight said in a report, annual home price growth rates are poised to continue falling in coming months normal home appreciation is about 3% a year. And so what's ultimately happened is over the last couple of years, people have grown to expect 10, 15, 20% home appreciation inside of a year. It's simply not going to happen. I believe we're not just going to get back the gains over the last 2 years. I think what's ultimately going to happen is I believe that interest rates are going to likely stay where they are, at least for the foreseeable future, if not just increase gradually. But what I ultimately think is going to happen is I think that we're going to see a lot less activity in the Airbnb space, a lot less home flippers. We're going to see a lot less real estate speculators. The real estate industry is going to be a lot less sexy in the next year or so. And I think what's ultimately going to happen is the entire landscape is going to change dramatically. That's a great time to get into the market. Like Carl Icahn said, the famous billionaire, he says the time to sell is when everybody wants to buy, and the time to buy is when everyone wants to sell. And I think that's what we're stepping into right now. We're going to be stepping into the time where everyone's going to start trying to leave and exit the housing market, almost like a fire in a movie theater. Much of that depends on how much inventory returns to the market. After seeing an uptick in listings in May through July, inventory levels stalled in August, growing at just 1/10 the rate in recent months. The market grew from 1.7 months of for sale inventory to 3.1 months after dropping down from 3 months in August. Right now, prospective sellers are not only coming to grips with falling demand and declining prices due to sharply higher interest rates, and they also have a growing disincentive to give up their own historically low interest rate mortgages in this environment. Some may be waiting out the market to see if demand and gas return in the spring. Demand and prices return in the spring. While 20% of markets have seen only marginal declines, less than 1% so far, a third have experienced drops of 3% or more, including 9 where home prices have fallen more than 5%. Black Knight researchers found the sharpest correction was San Jose, 13%, about 203,000, followed by San Fran, almost 11%, which is 140 grand almost. Seattle, 9.9%, or about 83,000. But other formerly hot markets have also cooled majorly since June. Las Vegas, Austin, Minneapolis, Washington, D.C., Raleigh, Nashville have all shed 3% of home values in the recent months. What do you think? Do you think we're going to start to see home values really start to punish? I believe if a buyer's purchasing power was just reduced, roughly 40%, there's no way home values are going to stay here. I think that the obvious situation is likely the home values are going to fall by that 40% in the higher end. And I think we're going to just see more and more and more support on the lower end products from institutional investors, deep pocket investors, and people forced to downsize. But I do believe that we are still going to see home values fall inside of that lower end price point, just not as much as the higher end. I think the higher end is going to go through the biggest squeeze. What do you think about it? Drop below. Hit the like button, subscribe here. Subscribe also on my second channel. It's an interactive call-in show on a podcast. And yeah, every single week I have someone either from finance, real estate, business. I mean, it's a really, really good show. So be sure to subscribe down there. I'll leave the links down below. If you need help fixing your credit, we'd love to help you at cashnow.video. That's cashnow.video. And then also, if you'd like to make money from home, we'd love to work with you at cashnow.video/money. It's completely free. We will train you. You need to work 1 hour per day. So 1 hour per day. The information for that is pinned down below in the top comment. LinkedIn, Twitter, Instagram, and TikTok up in the banner. And I'll catch you guys in the next video.